So any questions? Oh, now we've got a microphone this time around. Thanks, Wayne.
I've noticed that you've started to sell a few RHG. That was probably pre the last dividend.
Yes.
But given the stock's only fallen about 10 cents, are you selling out slowly, letting them go now?
Yeah, there's a question about RHG and the fact that we had sold a few RHG. I wouldn't, this is one of the problems when you run a fund and people see the announcements like that. I wouldn't be reading too much into that. The fact of the matter is we run this money for the closed-end unit trust, high net worths, and a high net worth trust, and some people can't benefit from the franking. So the idea, going back on it now, is we were selling some of those shares before the dividend for those shareholders who couldn't benefit from the franking, and potentially buying them back afterwards. So we're not, to put it in a nutshell, we're not strictly speaking a seller. Our shareholder base is not a seller of RHG.
Well, I might just add another one then. The RMBS market, has that been loosening up? And if it has, does that help RHG any?
Yeah, the question is about the RMBS market, or that part of the RHG book that is funded by the RMBS. And the answer is a little bit ambiguous. There were signs earlier on this year that some of the institutions outside the top 4 banks were starting to raise money in that market, and there were signs of life. And then we're hearing again more recently that those signs of life are not really there, but then we're also hearing that the big 4 banks are for want of a better description, they're vertically integrating and taking on some of those positions because they make their interest rate plus that incremental interest rates from the RMBS. So that's just in layman. There's a little bit going on, and people are seeing a few opportunities there, but the market overall is probably slightly better, but not significantly better than it was. Not so much better that it would have a really big effect on RHG, put it that way. Yeah. Are there any other questions?
I know you have to benchmark against something, but is the All Ords such a good benchmark, given that you're agnostic about the way you pick stocks in terms of a mandate, whereas the All Ords is pretty much banks and resources. And that's the first part of the question. Second part, and excuse my ignorance here, All Ords accumulation includes dividends?
It includes dividends, but not franking. So the second part of the question first, the All Ordinaries Accumulation Index includes dividends, but takes no account of the franking that those shares have delivered. That the shares that make up the All Ordinaries Accumulation Index have delivered. Why I've been highlighting that a few times to people is because on average, and this is an average, the All Ords Accumulation Index has a 4% yield. And so the franking you receive on that 4% is a portion of that 4%. On average, we pay a much higher yield than that. So the franking that we deliver is much higher than that as well. So you're not comparing the same thing. The first part of the question was, we benchmark ourselves against the All Ordinaries Accumulation Index. Is that the right benchmark? And in times gone by, people have said, this comes up in every cycle, it comes up in a different format. Is that the right benchmark? Or should cash be the right benchmark? Or should the Small Ordinaries Accumulation Index be the right benchmark? Or should LIBOR be or something? And it just depends. And it's funny enough, it depends how things are going. When the market's going really badly, and you're down 10% and the market's down 20%, people say, well, shouldn't the index be cash? So we don't care that you've outperformed the market. We don't want you to lose any of our money. Then in good times, I say, well, maybe it shouldn't be the All Ords Accumulation Index. Maybe it should be something else. But it is, in the end, we have to do something, because the reason and this is a very important philosophical and kind of for us a very important point. If you don't have a strategy designed to outperform an index, or designed to outperform and get rewarded for that, you won't outperform. If your job is to come into an office on a day and replicate the index, or a little bit this side of the index, a little bit that side of the index, and then write a monthly newsletter saying I'm 1% underweight banks, or I'm 1% overweight resources, but I'm basically replicating the index with a slight variation. If that's your job, you'll do the job to the best of your ability. You're not being paid to deliver a product that outperforms. And so we stand by the view that we want to be rewarded for outperforming the All Ordinaries Accumulation Index, because we want to make that the thing that we're trying to do, as a minimum. As a minimum, if we can, only to the best of our ability. The way I thought of it, I was trying to think of a way to write that down, and it might be that we're striving to outperform the All Ordinaries Accumulation Index. We can't guarantee it, but we're trying to do that. And I always go back to, and actually I haven't said it today, I'm trying to do that. I'm the largest shareholder. My funds are in this business. I'm trying and striving to outperform the All Ordinaries Accumulation Index. And my shareholders, all of us, are next to me trying also to get that outperformance above the All Ordinaries Accumulation Index. That is what we're trying to do. But that's our goal. It isn't to replicate the index or to be 1% underweight resources or 1% overweight banks. We're not trying to do that. I understand the shortcomings of it, but of having that index, but there isn't much more. Yeah, we've been asked that question a lot, the optimal size of Cadence. We feel that we've always said we don't want to grow too quickly. Again, it comes back to this thing because it's our own money. If we were a manager and we didn't have our own money in the fund and we didn't earn a performance fee, our number one priority would to be get as big as possible, as quickly as possible. That's not our fund. We're the biggest shareholders. We earn a performance fee. We feel that at about $250 million, we're thinking we will evaluate the strategy. We think we're going to run into problems above $250 million. We think that many people, we think we're going to run into problems. That's not a comment on how other people manage their money. We think with our strategy, it will be more challenging to produce 13% per annum alpha, running more money than that. And it's challenging to produce that in the first place. I mean, let's not. So yes, there is the point is there is a natural constraint to how much money the strategy can run anyway. This constraint to how much money the strategy can run.
Where's the next RHG coming from?
The question was, where's the next RHG coming from? And it's funny, I was reflecting on that. I was lucky enough 2 days ago to meet the chairman of Macmillan Shakespeare, and I spent some time with him, trying to understand, how he's become so experienced at what he does, and that actually has been the best performing stock for us. Macmillan Shakespeare has been a 26 bagger. It was a 50-cent float, and it's $13 today. So what the question really I like to, when I think of it, is where is the next Reckon 20 bagger, Macmillan Shakespeare 26 bagger, Avoca 10 bagger, RHG 10 bagger, Bravura double bagger. Where are all these next things going to come from? They're going to come from the same place the last lot came from, which is the ASX. So there's 2,500 stocks out there, and there's 700 of them made a profit. And of those 700, and actually this investment process, we meant to have it in the presentation here and we haven't got it today, but this is a reminder, we are going to put our entire investment process into the webcast in December so that people can look at it. And where it's going to come from is those 5% of undervalued stocks and 5% of overvalued stocks in the 700 stocks. So there'll be 35 cheap stocks in the marketplace over the next year, and there'll be 35 expensive ones. And that's it. In a year, we only see the real opportunity is in about 70 stocks, and it's going to come from there. And if I had to try and guess where it was going to come from, it's probably going to come from an area that people really loathe at the moment, and really would question why you would buy it in the first place. And it'll be very unpopular. When we buy the first 1%, it'll be very unpopular. When we put Macquarie Bank into the portfolio at $17, it was incredibly unpopular. We had a lot of inward bound telephone calls saying, why would you buy Macquarie Bank? I mean, everyone loves to hate Macquarie Bank. It's one of those things we just love to do. But the reality of it is it is a good business. I mean, when you walk in the doors there, in many ways, it's an amazing business. And the revenues are going up, the costs are coming down, and the cycle's changing. And so, for all I know, it could be Macquarie. It's not that long ago when we were having a bet that was it going to be CSL, Macquarie, or Rio that would get to $150 first, and they were all nearly at $150. And then Macquarie went to 16, Rio went to 32 and recapitalised, and CSL, to their credit, had a threat, and they're actually at 100 and, well, they're 46 times 3, aren't they? They're no, 46 times. I think they're over 150. CSL won. They won the bet. I think it'll be much the same as before. And I'm out there trying to find really bombed out kind of stories with. I think the same thing. I used to really get quite nervous about that. Every year on the 1st of July, I'd wake up and say, where are we going to make money this year? And it kind of isn't like that. It's kind of like you get up, ring some companies, go and visit them, learn that actually they've got 54 cents of extra assets on their balance sheet. Oh, well, we've got someone with us here today who took me to see API the other day, and I was looking at the story going, wow, there's all this stuff on the balance sheet that I didn't know about that's about to be released. I don't, and so I'm spending more time on it now, and I'm pretty sure there's not that many people know about it. And I'm not saying go out and buy API. I'm just saying I was pleasantly surprised to see all these hidden assets, much like the franking credits and the tax shield inside Cadence Capital Limited. Unless you tell someone about it, nobody knows. I think they're out there.
Carl, is an institutional placement significantly cheaper than, say, the option strategy that the gentleman just mentioned?
Do you mean for our company or for any company?
Well, for any company raising funds. Like
traditionally, for let's say a property development company runs into difficulty and they need to raise money in this environment. It's also environment dependent, the answer, but if they needed to raise money in this environment and their bank said to them, we're going to send you into bankruptcy unless you raise more money, you can be sure that that'd be done at a big discount, and it would be expensive for the existing shareholders. So it'd be cheap for the incoming shareholders, potentially, and expensive for the existing shareholders. And I would say in different times gone by, in order to entice companies such as ourselves to take the risk of owning other people's shares, at that point, we might want to get that at a 5, 7, 8, 10% discount to the prevailing share price at the moment, which is cheaper for us, potentially, but immediately costs the existing shareholders money. Now, in the case of an option, the option doesn't have that frictional cost associated with it. However, it does have the dragging effect on the existing share price, because the market immediately says, okay, well, if Cadence issues a $1.40 option strike now, and there's as many options as there are shares, when the shares go up 10 cents, they're actually only going up 5 cents, because 10 cents of that is split between 5 cents for the share and 5 cents for the option. So there's no, in true academic terms, there's no cost, there's no frictional cost to that. But unfortunately, the market doesn't really view it like that, because in times gone by, when you've had an option out there, people say, oh, and these options, you've got them out there and they're absolutely dragging your share price down, which they're not dragging the value proposition down, but it's just that the share price is not going up as much as it could have. So it's a more psychological cost than there's no actual cost, but there's a psychological drag.
Oh, there's also a real cost, because you've got to make an extra income just to cover the option.
There's the proposition here that there's a real cost, because you've got to make the extra income to cover the option at that time, and that becomes a bit of a balancing act, because it's kind of from that time forward. If from that time forward the market collapses and you're in cash, you're better off. If the market goes up from that point forward, you're worse off. So it's also market dependent. So I think, Ron, there's not a great answer to it, but traditionally, if you do a placement, we usually get it at a discount. So there's a cost to the existing shareholders.
That's why you have to deploy that 45 million quickly.
Oh, well, we have to do that anyway. Yeah, we have to either deploy that quickly. This is another great discussion we have inside the business. It goes something like this. Oh, Wayne, do you think, I shouldn't use Wayne all the time, but Wayne and Chris, do you want to be conservatively positioned? Yes. We need to be conservatively positioned. Okay, tick. Now, Do you want to be conservatively positioned for a bull market or a bear market? Well, I don't know if it's going to be a bull market or a bear market. So, okay, because if you can tell me if it's going to be a bull market, to be conservatively positioned, I need to be 100% long. But if it's a bear market, I need to be 100% cash. So, and so then the issue becomes, oh, wait a minute, but to be conservatively positioned sounded so tantalizing. And it does, like, you know, and also with the cash sitting there, the concept is it's so tantalizing to invest it. But if the market is going to head south from here in a meaningful way, we should actually be cashing up or shorting. And if the market's going to go up from here, then we should be buying more stock. Now, I just realized that I didn't express any particular view on that but I'm happy to do so. I am not as bearish this year as I was maybe last year and the year before, and I wouldn't read anything into that. Because I was quite bearish the year before last, and we had a great year. So I'm going to do what I said. I'm going to react to the circumstances as they're actually unfolding, not as to what I think. Like my academic pontifications of what the market might do are completely irrelevant. The market is going to do whatever it wants to do. Any other questions? Oh, and we haven't tried if there are questions from the telephone. How do we do that, Wayne?
Just ask
Oh, are there any? Geez, they would be waiting a long time to have. Are there any questions on the telephones?
Ladies and gentlemen, if you wish to ask a question on the phone, please press star 1 on your telephone and wait for your name to be announced. If you wish to cancel your request, please press the pound or hash key. Your first question comes from the line of Jeffrey Thomas. Please ask your question.
Good evening, or good afternoon.
Hi, Jeff.
Like it's almost evening, it's been a while. But just first of all, I wanted to thank you for the presentation and also for the opportunity. I'm in Melbourne, so it's saving me a trip up there, so I appreciate that. But I was going to ask you a question on the hybrids and
Yes.
also a lot of these new debt issues at the moment. I just wondered what your view of them was, Carl.
Yeah, thanks, Jeff, and sorry for keeping you on hold so long. I just completely forgot about the telephone questions then. Sorry. And in hybrids, yeah, we've had a good look at them, and actually I've had some experience with them this year. I've tried to invest in some of them, and it's actually been a terrible experience. I've been lured into this false sense of security that if you buy a hybrid, because you're getting a low return, your capital's safe. And what happened was I bought these things with a low return, and I lost money on the capital. So all of a sudden I got a low return and I lost money on the capital. And then I was watching a video by Mark Faber the other day, and he said, well, you know, we know what happens with all these hybrids and fixed interest and bonds and everything in difficult and fiscal cliff periods is since 1900, if you'd invested in them, you would have lost all of your money 3 times. So what happens with the hybrids, and I'm lured into this, is if I buy a share for $1 and my prognosis is wrong and it drops, say, to 90 cents, I sell a third of it. And then 80, I'd sell a third, and 70, I sell a third, and I'm out of it, and I've lost about 15% of my money overall. If I buy a hybrid, I'm going, oh, well, I'm getting a low return, but my capital's safe. So here I am, I've paid $100 for the face value of this thing. No, I've paid 50. This is how I got lured into it. They said, oh, it's $100 face value and you can buy it for $40. So I was like, ooh, that sounds like a bargain. Like it's $60 off the $100 face value. So no sooner had I bought it for $39 than it dropped to $29. And I was like, oh, but that's okay because my capital's safe. If I just hang on to the end, my capital's going to be safe. No sooner had I made that decision than it had dropped to 19. And this is just, it's mindless how naive I was. And so then no sooner had that happened than it dropped to 14. And then I went, hang on a minute. This hybrid that I own is a debt instrument over a company that's losing money and going out the back door. I would never, ever own this company. Why do I own the hybrid? And the next day I sold the hybrid and it went to $9. So my message there is, and Jeff, I don't know if you could see the numbers here on negative real interest rates, that none of this stuff's going to help you. Like if you buy the hybrid and you're in a negative territory, you're going to be in a negative territory. And if you buy the equity, you're in a negative territory. But what is going to help, what helps us is if we own it at $1 and it drops to 90, we've got systems and methodology and process for getting out of it before we lose. Before you know it, we'd paid $39 and I was selling it at $14. I mean, I lost 66% of my capital. That would be if I had any say in that matter, if that had happened to an equity, I would have already been out of it. Please don't get lured into the into thinking that your capital's safe in a hybrid.
Unless it's backed by an LIC, perhaps.
Sorry?
Well, just going to say, perhaps if it's backed by an LIC, because you've got AFI and also Whitefield who've issued these hybrids, and they're both selling at more than a 10% premium now.
Yeah, and I can't speak for each of those hybrids because I don't know them that well, and I don't want to pass. I can't obviously express a view on the investment process and how they make or lose money or what they do, but can I just say as a proposition that if those LICs were to lose all of their capital, the hybrids would be worthless. I'm not saying they're going to lose all of their capital. I'm saying if they were to lose all of their capital, the hybrids would be worthless as well.
Yeah, that's okay. All right, that's fine, Carl.
Yeah.
I'm happy with what you're doing.
Thank you. Any other questions? Might be. All right, ladies and gentlemen, thanks very much for your time today and also for your continued support with Cadence Capital Limited. We'll look forward to seeing you again in a year's time. Oh yeah, there's tea and coffee outside. No sandwiches this year.